Assets ranked, from financial traps to true wealth machines. Hey everyone, welcome back to the channel, where we talk about building long-term wealth the smart way. And we also talk about something just as important, living a healthy life. Because at the end of the day, your health is your first wealth, and everything else gets built on top of that foundation. Now, before we dive in, just a quick, honest note. You do not have to hit that subscribe button unless you actually feel like this video gave you something real, some value, some new way of looking at money, business, or life. We are not here to chase numbers. We are here to help you think a little differently. So if this content ends up helping you, great. And if you want more of it later, the subscribe button will be right there waiting for you. All right, let's get into today's topic, because we are ranking the most common assets people actually invest in, from F tier all the way up to S tier, kind of like a video game tier list, but for your money. Now, just to be clear up front, this is not financial advice. We are simply walking through the data, the historical returns, and the real risks, and stacking everything into one tier list you can use as a reference. To keep things simple and easy to picture, we are going to imagine what would statistically happen if you took $100,000 and put it into each and every tier. Some of that money is going to shrink. Some of it is going to crawl forward slowly. And a few of these tiers can genuinely build life-changing wealth. So, let's dive right in. Chapter 1. F-tier assets, the worst wealth builders. Let's start at the very bottom with F-tier assets. And honestly, these are financial traps dressed up to look like investments. They are not really investments at all. They are more like hobbies, status symbols, or straight-up gambles wearing an investment costume. They look exciting on the surface, sure, but over time, they quietly destroy wealth instead of building it. The clearest offenders here are lotteries and gambling. Americans spend over $100 billion a year on lottery tickets, according to the North American Association of State and Provincial Lotteries. And the average adult throws away more than $1,000 a year chasing these jackpots. The odds of actually winning are roughly 1 in 300 million, which means, statistically speaking, you are more likely to get struck by lightning than to build real wealth this way. Right alongside gambling sit luxury consumer goods, cars, watches, jewelry, designer fashion, even the newest phone bought on a payment plan. These are not assets. They are liabilities wearing a nice outfit. A brand new sports car can lose half its value within the first 5 years. And Warren Buffett himself has warned for decades that cars are one of the worst investments you can make if you are thinking in terms of actual return. That same logic applies to nearly every status symbol out there. They make you look wealthy while quietly draining your real capital in the background. Then there are collectibles bought without any real expertise. Think Beanie Babies back in the 1990s, or the NFT craze more recently. These fads convince beginners they have found some kind of shortcut to fortune. But without deep industry knowledge and serious patience, most of these end up worth close to nothing. Even in more established categories like fine art or rare cars, liquidity becomes the silent killer. You might be holding something genuinely valuable, but if no buyer ever comes along, your money is simply stuck. What ties every single F-tier asset together is a confusion between consumption and investment. These are emotional purchases, not financial ones. Real assets either produce cash flow or compound in value over time. F-tier assets do neither. They drain your wealth while tricking you into feeling like you are playing the money game. Now imagine putting $100,000 into this tier. In the lottery, it simply vanishes. In luxury goods, it loses half its value within a few short years. And in speculative collectibles, it may never even find a buyer. Instead of compounding into financial freedom, that $100,000 gets eaten alive by depreciation, terrible odds, and false promises. Chapter 2. D-tier assets. Weak, but not completely hopeless. Moving up one level, we land on D-tier assets, and these sit just one step above a financial trap. They can work, they genuinely can, but the odds are still stacked against you here. They tend to be too volatile, too illiquid, or too dependent on pure luck to serve as a stable foundation for building wealth. People do sometimes hit wins in this tier, but the majority of investors end up disappointed. Commodities like gold and silver land right here in D tier. They are often marketed as safe havens, and to be fair, that is true. They have preserved wealth for centuries. During times of crisis, like the 2008 financial crash, gold spiked more than 25% in a single year. But when you zoom out and look at the bigger picture, the story shifts quite a bit. According to the World Gold Council, gold's long-term annualized return over the past 50 years sits around 7 to 8%, which is less than stocks and only slightly above inflation. Commodities simply do not generate any cash flow. They just sit there quietly. As a hedge against uncertainty, they make total sense, but as a core wealth builder, they tend to disappoint. Single rental properties can also slide into D tier, especially for small, individual landlords. On paper, it sounds simple enough. Buy a house, rent it out, let the tenants cover your mortgage. In reality, it gets messy fast. Vacancy risk, property taxes, maintenance costs, and rising interest rates can flip the math from positive cash flow into negative cash flow surprisingly quickly. Census Bureau data shows that mom and pop landlords who only own a single property tend to face the highest default and vacancy risks in the entire rental market. Without any real scale behind you, rental real estate becomes pretty fragile. And that fragility is really what ties D-tier assets together. They might work perfectly under ideal conditions, but they lack durability. They depend heavily on timing the market correctly, avoiding bad luck, or getting every single variable just right. And let's be honest, that is not always going to happen. In D-tier, your $100,000 is not destroyed instantly the way it is in F-tier, but it tends to stagnate or bleed away slowly over time. And obviously, that is not the goal. The goal is to actually grow your wealth consistently, not just barely maintain it. Chapter 3. C-tier assets. Average, but not particularly exciting. Next up, we have got C-tier assets, and these represent the true middle-of-the-road category. They are not scams, and they are not traps either, but they are also not real engines of wealth creation. They usually keep pace with inflation and sometimes deliver fairly steady returns, but they rarely accelerate anyone toward genuine financial independence all on their own. Bonds are the clearest example sitting in this tier. United States Treasury bonds are considered one of the safest assets out there. Investors buy them for stability, not for growth, and stability is exactly what they deliver. Over the past 30 years, 10-year treasuries have returned about 4 to 5% annually, compared to more than 10% for the S&P 500 over that same stretch. Bonds protect your wealth, but they simply do not multiply it. They are basically the financial equivalent of parking your car in a garage, safe, secure, but going absolutely nowhere. Then there are REITs, or real estate investment trusts, which also live in C tier. These give everyday investors exposure to property markets without ever having to manage tenants or physically buy a building themselves. REITs often pay attractive dividends, which makes them popular with income-focused investors, but they are extremely sensitive to interest rate cycles. Back in 2022, when the Federal Reserve hiked interest rates aggressively, the FTSE Nareit All Equity REITs Index lost over 25% of its value. Over the long run, REITs tend to underperform broad stock market indexes while still carrying higher volatility. They are useful inside a well-diversified portfolio, but they are far from the dominant force. Then we have collectibles bought with real expertise. Think fine art, vintage cars, and rare watches. Unlike the speculative fads down in F tier, these markets are real, and genuine fortunes have been made by savvy, knowledgeable collectors over the years. Deloitte's 2023 Art and Finance Report found that ultra-high net worth individuals now allocate about 5% of their portfolios toward art. But here's the recurring problem: liquidity. Selling a Picasso or a rare Rolex at the right price can take months, sometimes even years. Unless you already have serious industry connections, these investments often end up functioning as status symbols, rather than true cash-generating assets. C-tier assets all share one common trait. They are fine, they will not ruin your finances, but they will not make you rich either. They function best as diversification tools, things you sprinkle into a portfolio to smooth out overall risk, but they are definitely not the heavy lifters of real wealth creation. Chapter 4. B-tier assets. Solid, but not quite the best of the best. Now we are getting into more exciting territory. B-tier assets are where real wealth building genuinely starts to feel reliable. These are not flashy assets by any means. They do not require insider connections. And honestly, millions of everyday Americans have used them to climb steadily into financial independence. They compound consistently, they are proven over decades, and they are accessible to basically anyone. The only reason they are not ranked even higher is that other asset classes outperform them over long stretches or offer significantly more leverage. Index funds are the true cornerstone of this tier. A simple S&P 500 index fund has returned about 10% annually since its inception. To put that in perspective, if you had invested $10,000 back in 1980, you would have well over $900,000 today without ever lifting a finger. They are cheap, they are diversified, they are liquid, and they require essentially zero active management. Legendary investor Jack Bogle built the entire Vanguard company around the simple principle that most people should stop trying to pick individual stocks and instead just ride the broader market. For the average American investor, this remains the cleanest, most reliable path toward long-term wealth. Then there are dividend-paying stocks, which also live in B tier. Companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble have raised their dividends for decades straight. The S&P 500 dividend aristocrats, firms that have increased their payouts for 25-plus consecutive years, have historically performed better than the broader market while carrying lower volatility. Dividend investing tends to appeal to people because it genuinely feels like cash flow. You are literally getting paid just for owning the stock. The trade-off is growth. High dividend payers usually grow more slowly than reinvestment-heavy companies like Amazon or Google. Reliable? Absolutely. Explosive? Not really. Rounding out B tier is real estate at scale. A single rental property can be pretty fragile, as we mentioned earlier, but once you own somewhere between 5 and 10 properties, the risk of vacancies or problem tenants starts spreading out across a wider base. That is exactly when real estate starts feeling like a genuine system instead of a gamble. According to census data, about 70% of rental properties across the country are owned by individuals, but it is really only landlords with multiple units who tend to experience real, lasting stability. Done correctly, this delivers steady cash flow, along with long-term appreciation. The main challenge remains management, though. Even with a property manager handling the day-to-day, real estate still demands more personal involvement than simply buying an index fund. The common thread running through all of B tier is repeatability. These assets do not rely on luck or perfect market timing. They work for basically anyone who sticks with them long enough, but they do not carry quite the same upside, leverage, or scalability as the very top tier. So what actually happens if you put $100,000 into B tier assets? That money genuinely goes to work for you. In index funds, it could compound into roughly $1 million over 30 to 35 years. In dividend stocks, it could steadily pay you somewhere between $3,000 to $5,000 a year in income while still continuing to grow. In real estate, it could be leveraged into multiple units, producing consistent monthly cash flow along the way. Chapter 5. A-tier assets. Powerful, but genuinely demanding. Now we are moving into A-tier, and this is really where the entire wealth game starts to shift. A-tier assets carry serious potential to generate real wealth, but they are absolutely not beginner-friendly. They demand a lot of capital, a lot of skill, or a whole lot of patience, sometimes all three at once. But if you can clear those hurdles, they will reward you far beyond what any middle-of-the-road asset ever could. Private equity and venture capital dominate this tier. Historically, private equity funds have returned somewhere between 12 to 15% annually, consistently beating public stock markets over time. A 2023 Bain & Company report confirmed that top-tier private equity funds still outperform the broader market, even after accounting for their fees. The trade-off here is accessibility. These funds typically require at least $250,000 just to get in the door, with your capital locked away for 7 to 10 years at a time. And honestly, you often need the right industry connections just to hear about these opportunities in the first place. Then there are franchises, which also sit firmly in A tier. The underlying business model is genuinely rock solid. You are buying into a proven brand, with built-in marketing systems and an existing customer base already in place. Top American franchises like Chick-fil-A, McDonald's, or Domino's can generate 6 figures in profit per single location. And according to Franchise Business Review, operators average somewhere between $80,000 to $100,000 in annual profit. But the barrier to entry here is massive. Opening up just one location can cost anywhere from $500,000 to well over $1 million, and not everyone even gets approved by corporate to begin with. It is not that franchises do not work. They clearly do. It is simply that very few people can actually afford to get a good one up and running. Rounding out A tier is commercial real estate. While single-family rentals can feel pretty shaky, Commercial properties. Think multifamily apartment buildings, office towers, or shopping centers. Scale income in a way that small, individual landlords simply cannot replicate. According to CBRE, United States commercial real estate has averaged about 9% annual returns over the past 25 years. But again, the entry ticket is steep. Even a modest multifamily property might cost anywhere from $1 to $5 million, and lenders typically expect significant equity upfront before they will even consider financing the rest. The pattern across all of A tier is pretty clear. These are proven wealth machines that demand serious buy-in from the start. They are not risky fads, and they are not dependent on luck. They are scalable systems that produce strong returns, but only if you can actually afford to play the game. So what happens if you put $100,000 into A tier? Honestly, it is barely enough to get through the door. It might buy you a minority stake in a small private equity deal, serve as a down payment toward a modest commercial property, or cover part of a franchise fee without covering the full build-out cost. A tier really shows you that capital acts as a gatekeeper here. The opportunities are genuinely great, but with only $100,000, you are still mostly standing on the outside looking in. Chapter 6. S-tier assets, the true wealth machines. And finally, we have arrived at S-tier, the true wealth machines, sitting right at the very top. S-tier assets are the crown jewels of wealth building, combining growth, leverage, and scalability in ways that lower-tier assets simply cannot touch. At the very top of this tier sits owning your own business. According to the United States Census Bureau, over 70% of American millionaires are entrepreneurs. A profitable business essentially pays you twice, first through steady, ongoing cash flow, and later, when you eventually sell it for a multiple of its earnings. For example, a small sauce company generating $500,000 in annual profit might sell for anywhere between $2 to $5 million, depending on its growth trajectory. No stock and no bond could ever realistically deliver that kind of asymmetric upside. Next in this tier is equity and high-growth companies, startup founders, early employees, or angel investors who get in early on the next Tesla, Amazon, or Nvidia can see truly life-changing returns. A $10,000 investment into Amazon's 1997 initial public offering would be worth well over $1.6 million today. These kinds of wins are rare, sure, but when they land, they build generational wealth for entire families. Another modern addition to S-tier is scalable digital assets. The creator economy was valued at over $100 billion, with top creators earning millions of dollars annually. Scalability is exactly why digital assets punch at the same weight class as owning a business or holding equity. The same handful of underlying forces are at play. The pattern running through all of S-tier really comes down to leverage, money, technology, or other people's effort working for you, instead of you working for it directly. Unlike lower-tier assets that depend on slow, steady compounding or personal labor, S-tier assets multiply because they are built to scale far beyond any single person's individual effort. Summary. At its core, this is the story of how not every dollar you invest is created equal, and how understanding the tier a particular asset sits in can completely change your long-term financial trajectory, starting from F-tier financial traps like gambling and depreciating luxury goods that quietly destroy wealth, climbing through fragile single rental properties and commodities in D-tier, steady but unremarkable bonds and REITs in C-tier, reliable and accessible index funds and dividend stocks in B-tier, demanding but powerful private equity and franchises in A-tier, and finally arriving at S-tier, where owning a business, holding equity in high-growth companies, and building scalable digital assets create the kind of leveraged, compounding wealth that no amount of patience with lower-tier assets could ever fully replicate. And the real takeaway for most everyday people is that you do not necessarily need access to the most exotic, complicated strategies to build real wealth. You mostly just need consistency, patience, and enough discipline to avoid the traps sitting at the very bottom of the list. Alright, that's going to wrap up today's deep dive. If you found value in this one, you know what to do. But again, only if you genuinely got something out of it. Thanks so much for spending this time with us today, and we will catch you in the next one. Until then, take care of your wealth, and take care of your health too, because that's what this channel is really all about. Thanks for watching. See you in the next video.